Fantastic. All right, folks, we are going to continue with our next session. And it is my privilege to introduce our next two speakers. The title of the session is REIT and Private Equity Titans Comparing Notes. And by any measure, they are indeed titans of the industry. DEBRA CAFARO is the chairman of the board and chief executive officer of Ventas, an S&P 500 company and real estate investment trust that owns more than 1,200 healthcare, life science, and senior living properties in North America and the United Kingdom. An industry visionary by any measure, Debbie set and oversaw execution of a long-term strategy that has driven Ventas's market capitalization to $26 billion from $200 million since her leadership began in 1999. The company's compound annual total shareholder return has exceeded 22% during her tenure. Widely acclaimed for her enduring business success, Debbie holds a long list of professional recognitions. Among the highlights in 2017, Forbes named her one of the 100 world's most powerful women, which was her second time on the list of global political, media, entertainment, and business leaders. Harvard Business Review has recognized her for 5 consecutive years as one of the 100 best performing CEOs in the world, of which she is one of only 3 women. The list, quite deservedly, goes on and on. KENNETH KAPLAN is a senior managing director and global co-head of Blackstone Real Estate. In case you were unaware, Blackstone has the largest real estate platform in the world, with more than $115 billion in investor capital under management. Blackstone Real Estate is the industry leader in opportunistic, core plus, and debt investing across the United States, Europe, and Asia. Ken has been involved in some of the biggest and highest profile deals that we talk about in academia and in industry, including more than $100 billion of acquisitions and initiatives in the United States, Europe, and Asia, including Equity Office, Hilton Hotels, and GE Real Estate. It is my privilege to welcome to the stage DEBRA CAFARO and KENNETH KAPLAN.
Great. Good afternoon, everyone, and thank you for staying. This is a great new format, and
we thought we'd try something a little different here.
Exactly. And if you know anything about Ken, I think sparks are going to fly. So don't leave your seat. Yeah. So why don't you start?
Okay.
See, sparks are going to fly, guys.
Not quite comedians in cars, whatever, but drinking coffee. But we're going to try to have a casual conversation here, depart from the panel format. And we thought actually would also be interesting, because you're hearing a lot about what's happening in the markets, what people are seeing, which we'll touch on as well. But here you have a publicly traded, sector-focused REIT. Right, and Debbie's obviously been at the head of that REIT for 20 years, and as you heard Sam say, just extraordinary leadership. And by the way, 20 years, that's something that's worth, I think, applauding.
Thank you, thank you.
And not only 20 years, but the returns over those 20 years, like the 20+% returns and 2,400%, I think, overall shareholder return. And then we're a private fund investor, right, in real estate funds, also large scale. So you'd think the two of us would have businesses that are quite different. But as we've known each other a long time, we've done business together as well. And actually, when you look to the ethos of our business and how we approach each of our businesses, there are actually a lot more similarities than I think you'd expect from the surface. So we thought we'd talk a bit about that, some of the similarities and differences between our businesses, how we've both gotten our businesses to where they are today. I haven't been running the Blackstone real estate business for 20 years. It's only been a little over a year, but I have been at Blackstone for 22 years myself. So we're going to start there and maybe talk about both of our businesses and how, what some of the keys are to that success and how we've gotten our businesses to where they are today. So I'm happy to start with that. Or do you want to talk about that, how you've gotten your business, some of the keys to growing and creating a great real estate company?
Well, thank you. So one of the similarities of our businesses, and unlike many REITs, we have been more of an acquisition or investment vehicle. And that's not always the case. It comes really from our tortured history in part. But that is a similarity that we share. We're doing a lot of investing all the time. And so I think one of our keys at Ventas, like yours, is really making excellent forward-thinking capital allocation decisions in making investments and being in different sectors at the right time. I think both of us would agree that our teams are incredibly essential, the teams and the cultures, to the success of that business. And then the drive and the discipline that we have, and really finding a place in the market where we have a competitive advantage. And those have all been things, along with a prodigious work ethic, that I think have helped us at Ventas continue to grow the firm through various cycles and deliver for our stakeholders.
Yeah, so I'd say that's you could have been describing a lot of what we do in the same exact way. So, we're constantly redefining, where we have convictions. You're doing that, across, pretty innovative in terms of how you've evolved the business over the years, and I feel we've done the same thing. It does all start with, the people and the culture and the focus and approach, right? And your company has obviously been transformed, many times over the years. Blackstone as well, where it was 20 plus years ago versus today, you'd hardly recognize by size. But, when you go to the essence and the culture and the approach and the people, that's really the same, right? We have a focus on delivering performance and results for our investors, same thing, right? It's all about performance, and everything else kind of grows out of that. And doing it, in the right way, right? We've built a reputation, both of us. We do what we say we're going to do, highest integrity, working hard, caring more, acting as owners, and that really, that's who we are, and that's who you are, and that's a big part of it, right? And it doesn't really matter if you're in a public company or a private fund. So, it's amazing when you look back how the companies might be very different sectors or unrecognizable in size, but really the essence of what we wake up and focus on doing every day is really the same. And I think that is really important for the success of both businesses.
In reading about sort of how the market has performed over the course of this cycle, all indications are that for a small investment manager, it's become more difficult to raise funds than it has been historically. Both of you in your firms have experienced tremendous growth, certainly for Blackstone, also for Ventas. Is it harder today for a relatively smaller firm to experience the kind of growth trajectory that you've been able to engineer, or is it simply a different dynamic?
Well, the scale is a huge advantage for us in our business. So, and I think that is one of the things you have to find, where you have a differentiated position, where you might have a different view. You don't have to necessarily be a large-scale player, but for us, that is one of the areas that we find we have a huge advantage. So, and that scale brings the obvious thing is we can do things that others can't in terms of buying a publicly traded company. I know some earlier panels talked about that, some things that we completed on, some things that maybe we didn't complete on. But we can do that when there's a multi-billion-dollar, when GE's selling their, you referenced this in my bio, their real estate business, there aren't many groups that can do that. So there are the obvious advantages of scale for that. The scale also allows you to attract incredible talent, which only has gotten stronger every year for our business at Blackstone and also in our portfolio companies. And that talent is key. It's in identifying new opportunities, it's in operating our assets, it's in then harnessing the data that comes from the assets and establishing relationships and guiding us to the next investment that we want to make or the next theme. So the scale can bring great advantage. It's not the only way to have a successful investment business, but for us, it's been hugely positive. It brings challenges too, obviously, because a bigger business, more complicated to manage, and with the large scale capital we have, and Debbie, it's the same thing for you, right? We have the ability, or could look at everything, but then if you're not focused on your conviction themes, you'll end up being the jack of all trades or master of none. You won't really, in my mind, have the same impact. We're not just index investors. We are conviction investors, and you have to maintain that focus and that discipline on where you see those best opportunities.
Yeah, in my observation, and we admire Blackstone greatly, and again, are simpatico, I think, with the people, but what I've observed from the outside is that, and I hope we emulate this too, is you get the big things right, and then you execute
Right.
the little things a little bit better consistently than everybody else. And that's a very powerful combination. Right. And you figured out kind of, okay, where we have the scale, if we get those macro thematics right, we can go in and be really the only player for some of these opportunities. And if we don't screw it up by over negotiating, retrading, and doing those things, we'll have a great market essentially to ourselves. And I think that's been a huge competitive advantage from the outside looking in.
Well, I'm really happy you said all that, because that is absolutely what we're going for. And how
you can give me the $100 later, Ken.
We can bring you to the next meeting that we have, because that is really the approach. I mean, we do work to have these conviction themes. So like buying logistics. Everyone now loves logistics and warehouses and the Amazon and everything else. We've been doing this for several years, and we've been doing it in a big way. We bought 680 million square feet of warehouses, or whatever the number is around the world. But it really started by doing this, 9 years ago or so now in the US, seeing everything outperform, getting the data from that, then expanding that into Europe, doing this in Asia as well, continuing to see where the demand then is evolving to more infill sites and getting more active there, and using the data. But it's starting with this kind of big picture. And then, yes, we try to operate more than a little bit better, but we try to operate a lot better.
But if you do a little bit better consistently, that...
Yes, try to then apply operations and best-in-class management teams, and do things in large scale. And to your point also, be user-friendly and, obviously not just be pushovers, but be good counterparties and not retrade. Do what we say we're going to do. I think is really important, and part of why I think if someone wants to transact with a counterpart, I think it's the same thing with you, right? I mean, if you want to transact, we provide lots of certainty of both capital, and that we'll get it done.
Mm-hmm.
Right?
And one of the things though that is I think quite different, and I wonder about how it changes our management and investment philosophy, is that you have to sell. I mean, your business model is around selling.
Right.
Ours is as a effectively perpetual life, perpetual owner of assets that produce sustainable cash flows. And I think one reason that Ventas has been able to outperform for a long time is this concept of perpetual life. And one of the issues that we talk maybe about in private equity is that
we have to sell.
Vintage is one of the most important aspects. So you have to buy when you have the money, and then at some point you have to sell. And that, how do you think that changes? For us, it does change our investment decisions, but how does it affect what?
For us?
Yeah.
Well, it's interesting. So we have, and Debbie's referring to our opportunistic funds, closed-end vehicles. We get capital commitments, and then once we get a size of fund is established, and then we invest those capital commitments as we get to the end of that, and then we raise a successor fund to that. Now we do have long investment periods, which gives us the ability to be patient with that capital and discipline, and you have to be.
Yeah.
Otherwise, we would not be where we are today. And I think you've heard from others and seen in some even public situations where we like a company or an investment, but at a price. And if it goes beyond that price, then someone else could get that transaction done, and it won't be us. But it is a buy, fix, sell strategy, and it does, and that's what our investors are giving us capital to do. And as we've stabilized the assets, we then do sell them, and then we have to redefine ourselves and go out and do it again. And that's the nature of the capital, and that brings with it positives in that we have the commitments and that we can act quickly, and we don't have to go and find the capital elsewhere when the transaction comes up. And it's well suited for that. Now, we've been evolving a little bit towards your model, which is in our Core Plus business, it's perpetual capital. So these are open-ended funds, institutional capital in US, Europe, and Asia, and we have a private REIT now, which is obviously very similar, but not publicly traded.
Right.
Where it's B-REIT. So, and that's been great. But for that, we're buying more substantially stabilized assets, a combination of current income and appreciation, and it's more appropriate for that to be in a perpetual life vehicle. I mean, I assume you being a publicly traded company, how do you view it with your capital structure and being listed?
Right. I mean, it's to me been a huge advantage. I mean, being public has, like everything else, its pros and cons. I think the perpetual life of REITs, I mean, REITs have outperformed for decades in terms of return on a fairly low leverage model. For me, it goes back to the capital allocation, is the way that we've delivered value has really been to start with the thesis around an asset class, this whole capital allocation theory, whether it was investing in senior housing before it was an institutional asset class. I used to call it, core-like characteristics with above core returns, and really getting into that asset class in a big way. Then moving to medical office when we could buy that at 9 cap, now 5 cap or below assets. Now moving to research and innovation on university campuses, which we'll talk about in a minute. Right. And continuing to buy companies as well. And we do have a good currency option with our stock and doing tax-exempt deals for counterparties. And so it's been a mixture of all those things, and using the right tool, getting into the right sectors, and importantly, getting out of the right sectors like skilled nursing. When we saw an opportunity to do a tax-friendly deal at the highest valuations I had seen in my career in 20 years for that asset class. So perpetual life, but constantly changing the content of what is within the enterprise, and hopefully over time really elevating the quality of the assets, the quality of our partners, the quality of the cash flows.
Tell us about the university piece.
Yeah, I mean, I think what Debbie's saying, and we should talk about the university piece, because it's something actually that we have completely in common, because it's a transaction we did together.
Right.
But I do think first of all, what you described, which is really amazing, what you did at Ventas, or what you're doing at Ventas in terms of, continually evolving what's in the company, right? And same with us. I mean, what we owned in Blackstone in our funds 15 years ago, which was mainly office buildings and hotels, and we still invest in office buildings, hotels, but now obviously a lot more for the past several years, logistics and rental housing and research and innovation or life science office. But it continues to evolve, and that innovation element I think is really important, right? And there's so much change happening, and if you just sit still, you're not going to obviously have those same kind of returns in either of our businesses. So, and what you described is not really typical of a REIT, right? Which is
it's
continuing
not.
to evolve.
Right. And it's a very exciting part of what, I'm not sure I could keep doing it for 20 years if we didn't have, healthcare across the board is a huge sandbox, and each of the verticals is very different from each other and very intellectually engaging. And so that's been really fun. And the newest one is getting into the research and innovation business. That's what we call it. It's really life science is affiliated with universities, leading research universities. And it's a really good story. We had tried to buy this business multiple times. It was a business called Wexford. And Wexford went through a series of transactions. They sold from a private owner to a public owner. Then the public owner was selling, and then we had the misfortune of bidding against these guys, and you know how that turned out. Yeah. And then we actually called Blackstone. My partner had a brilliant idea to say, that part of the public company that Blackstone is buying doesn't really fit in with the aspirations that Blackstone has. And so, but it does fit in with our business. We've tried to buy it a couple times, so let's get together and have a win-win. And so what ended up happening is you bought Biomed, okay? And then we bought from Blackstone the business that we had looked at called Wexford. And that was 2016. And it's really doing business with the leaders in university research. It's kind of has a medical aspect, like Penn Medicine, which is a nice component for us. And it was about $1.5 billion then. It's about, with the pipeline, about $3 billion now, pro forma for the pipeline. And it delivers reliable, growing cash flows with credit counterparties, i.e. the universities and people around the universities. So with nice escalation. So it fits with the Ventas business.
Yep.
And on the other hand, these guys are killing it with the,
so it's
you
a great
do your
story.
part.
So yeah, so I mean, and Debbie's referring, for those of you that are not aware, there's a publicly traded company, Biomed, that we privatized in the beginning of 2016. And as a life science office, research and innovation business, they had this research and innovation, we'll call it, right?
Okay.
So, and it was a nearly $9 billion company, right? And we had never bought anything in the space before. I don't think you had either, right? I mean, it was a new area for you.
We've been trying.
You've been
but
trying,
yeah.
but this is the first
Yes,
investment.
exactly.
And it's actually a good example of continually innovating and not relying on just doing what you had been doing. And by the way, now there's a concern, right? We're later in the cycle. What is there to buy? And in 2016, frankly, was a similar feeling. I mean, it wasn't exactly a time when everyone felt things were so obvious either. But here was this company in this space that we were fairly unfamiliar with. And the more work we did in this area, the more excited we got about the sector and this particular company, Biomed. And the reason for that was it was a fairly misunderstood area, right? These are people have this impression of lab offices being these, windowless, single-use, very specialized office buildings that, require lots of capital improvements. And if your tenant leaves, what are you ever going to do with the building? The reality is very, very different. I mean, these are, over-improved office buildings that actually could house a range of tenants, but are built to suit these life science companies, pharmaceutical and biotech companies, because they have higher ceiling heights and better load capacities and air handling and power and all that, and so the flexibilities business is much better, buildings much better than you would expect, and then the locations and what they own, they're in these nodes: Cambridge, Massachusetts, Seattle, San Francisco Bay Area, San Diego, all the places that you really want to be, and this university business. And the reason that these buildings are here is because this is where the talent is, right? And these companies need to be where the talent is, right? You can't attract the talent or you can, but companies need to be in these places. So, and as a result, the fundamentals in these markets and for these businesses are fantastic, right? In Cambridge, Massachusetts, you look at the vacancy and the rental growth rates and across the sector. So the more time we spent, the more enamored we got with the whole business. We ended up completing on this transaction, and it was about 16 million square feet, again, about $9 billion. And then about 70% of the assets were in these core markets. But there's about 30%, the biggest chunk of which was this university-based business, which is a good business. But when we bought the company, we said, why don't we just try to really focus the team on these core markets? And this we'll treat as more of a non-core. And we weren't necessarily looking to have to unload it or anything, but then Debbie had the interest in this business, and it had its own actually a very complicated transaction.
Oh my God, you have no idea how
right.
And this is also where I think one of the panels earlier today talked about trust. Yeah. This was a case where I think John and I basically, it was really complicated.
Yeah, super. Management teams,
and John
joint
said,
ventures, all sorts of stuff.
can you do this in this period of time? And I give all the credit to my partner, John Cobb. I don't know if he's in the room or not, but we said, yes, we can do it. And John trusted us and took a real risk in taking a direction. And thankfully, we were able to do it. And it was way complicated for $1.5 billion deal.
Super complicated. It was one of the most complicated things we've been involved with just because of all the different pieces, and we had just bought the public company and everything. But you completed, and you're fantastic to deal with. And that's, I think, part of the hallmark of you and your business as well, and same with us. And you said this earlier, it was a genuine, true win-win. I mean, the remaining Biomed business has been a fantastic investment.
Exactly.
I think this has been a fantastic investment for you as well. And we've looked to grow our business as well through developments and acquisitions. The only downside of completing on a large-scale transaction than you having invest too, is that it raised a lot of people's attention to the attractiveness of the sector.
I know,
and the whole
and
thing's
it's killing
re-rated.
us.
Yeah, so
Exactly.
it's harder to buy more.
Yeah,
basically.
and the other thing is, I think it really shows that you have to really understand, what your stakeholders, what you exist for,
Yep.
and to match what you're doing to what your stakeholders are buying you for.
Yep.
And I think that transaction really shows how we both
Yeah.
did that.
It worked really well for both of us. How about more, Debbie, in terms of, because that's one example of innovation, and others, and I know this is big for you in terms of, and us too, you given your portfolio a lot of data, harnessing that data, using it to your advantage and to be a better operator and better owner and investor as well.
Well, we're taking the whole data analytics, applied analytics to a whole nother level now. And we have a lot that we've done, but a lot more we can do. And I'll just give one small example. I mean, we are the second largest owner in the US of senior housing. We have lots of information. We are constantly thinking about where to expand, where to contract. There's obviously data you can get that is demographic in nature, that is household incomes and all the normal stuff. But we have been really going above and beyond and thinking about things like, I'll just give you one small example. So we can look at the data in a submarket and say, what is the level of prescriptions for certain types of medication that we know are commonly used for dementia, Alzheimer's, et cetera. That may give us insight in those markets as to whether we ought to expand our assisted living into Alzheimer's or dementia wings. And so, I mean, this is really, again, there's so much more we can do. That's one small example, but it really is helpful in terms of making the right decisions on capital.
Yeah. And we
All the students who are wondering whether or not they should take data science and real estate analytics in the fall, you heard it from Deborah CAFARO. You should absolutely be signing up for that.
Yeah, it's huge.
course.
Yeah.
And for us too, I mean, harnessing the data that, because we're all get tons of emails and lots of research, and a lot of it's very valuable, but what we get from our portfolio, and we're constantly looking to get more out of that. But we organize as portfolio companies and board meetings and seeing where your leasing activity is strongest, where you're getting good return on capital, where your occupancies are growing, where you're outperforming. I mean, it gives you lots of information on where you want to lean in more and get more, build more conviction or not, and where you might see similar backdrop for patterns to develop in other parts of the world or in adjacencies. So the data science part is and all the innovation, and because we're in a period of a lot of change, right? I mean, changes in how we shop, how we work, how we live, and that's shifting demand for real estate, and being able to see that through the data from our portfolios and yours is hugely valuable. And yeah, that's a big area for us.
I apologize, I have to wrap it up there. We've just about run out of time. What an amazing pairing. Thank you so much, everyone. Thank you, Ken and Debbie CAFARO.
All right.